We're here for a quick update. So John's here to talk to us about markets and the macroeconomy, and I'm here to talk about how that fits in with the portfolio. So John, why don't you take it away?
Thanks very much, James. Well, it's been a fascinating year. We've had really quite robust growth in the US, which wasn't expected at the start of the year. There was a concern that the aggressive Fed tightening that we saw about 18 months ago would feed through into much more weakness in consumption growth and the labour market, and it hasn't really happened. So we've had 3 solid quarters of US GDP. China's come off the boil, which is to be expected given the overinvestment and underconsumption that we see in the economy. Japan's been trundling along. Eurozone's been a bit weak. UK's held in quite well. So in the round, with a bit of emerging market growth as well, it's been a pretty good year of growth, certainly against the expectations of the start of the year.
And we've been talking quite a lot about a kind of reflationary story generally. And I think part of that reflationary story is all about slightly higher nominal GDP, a lot driven by inflation, but that drives slightly higher earnings. And that tends to favour kind of cyclical companies and cyclical areas of the market. And I think we've kind of, how we position the portfolio for that is we've seen opportunities, for example, in some UK companies and in the UK market, but also in the Japanese market, but also within the kind of subsectors. You know, we're looking at opportunities perhaps in the consumer discretionary area. So if I think about something within the portfolio, something like Next, which I'm sure we all know is a UK retailer, and the shares are up kind of 20% year to date. Only because I'm kind of mentioning the UK. We've obviously had the budget recently. I think it'd be remiss of us not to mention it. It'd be interesting to get your kind of initial thoughts on the budget.
Yeah, I mean, your comment about reflation is exactly right. I mean, one of the reasons why we are optimistic on equities in the longer term is because central banks and policymakers more broadly are trying to reflate the economy. And the major reason they're trying to do that is they've given up on the idea of shrinking the debt to GDP ratio by getting the debt down, by cutting government spending. Instead, they're trying to boost the denominator, which is the GDP part, and shrink the deficit that way. And yesterday's budget was a case in point where we had a little bit more fiscal loosening than perhaps the markets were expecting. And we had better front-end driven growth as well over the next couple of years. But actually, interestingly, a less robust growth trajectory over the 27, 28, 29 period. So I think with that in mind, the markets are thinking, well, perhaps it means a little bit more inflation in the near term, possibly less Bank of England rate cuts. And that's the reason why we've had gilt markets under a little bit of pressure the last couple of days, just reflecting the risk of a less benign central bank and also a little bit more in terms of government bond supply in future.
Yeah. So gilt yields have obviously kind of risen in that environment. So the interest rate that savers are kind of charging to the government has gone higher, and that kind of naturally leads on to the defensive part of the portfolio and where we're thinking about that, I guess. And we are kind of fully invested, I guess, in government bonds, but I think it's worth saying that we're positioning on in terms of slightly shorter maturity. So what that kind of means is that we are lending money to the government, but on a shorter maturity than would be kind of maybe typical in the portfolio. So something like a kind of 4 to 6 year maturity that we're kind of lending to the government. But also another area that I think that we're looking in terms of the defensive side is we still have that position in gold. It's kind of between 2 and 2.5% weighting in the portfolio. And I think that slightly feeds as well into some of our concerns, or maybe some of our thoughts, I guess, around the US election, which is obviously also coming up, sticking with politics. So I guess maybe where are we at with that, and what's your kind of thoughts on that?
Yeah, I mean, there's been the so-called Trump trade that's taken place in recent weeks as Trump's pulled ahead in the polls. Maybe the polls overestimate the lead that Trump has, but nonetheless, people have been buying big tech because that's clearly something that Trump will be well disposed towards were he to be president. People have been buying gold and also cryptocurrency as well. But gold in particular is something that we do like as a tail risk hedge against geopolitics. But also more broadly, this theme of currency debasement, lower real interest rates by the Fed as they cut interest rates further, but inflation begins to stay a bit sticky. And really, those are the drivers, I think, of this idea of gold that can perform both in a risk on and risk off environment. But as far as the election itself is concerned, it's going to be a lot tighter, I think, than markets are expecting. And I think we have to expect also that volatility will remain very elevated. So both bond market and equity market volatility have picked up markedly over the last 2 or 3 days. And that reflects people really squaring positions ahead of next week's vote to get themselves into a more comfortable position. And I think going forwards, were Trump to be elected president, we'd expect his policy to be reflationary, and supportive of risk assets. But at the same time, some of the weakness that we might see in terms of institutional focus could also be a bit of an issue, and it could give rise to periodic bouts of instability in markets as risk premia came and went in terms of US assets more broadly. But I think, Trump is a supercharged version of what we saw from the UK government yesterday. Much easier fiscal policy, much bigger deficits, much more focus on nominal GDP, reflationary in terms of earnings, but also volatile as well in terms of a very transactional policy response, which makes it quite hard to read.
Yeah. And I think if I just focus on maybe if I just pick up something that you mentioned there, gone kind of on the shorter term performance of the funds, the dollar strength and the tech strength has been a bit of a headwind in terms of performance. As I mentioned earlier, we have had a bit of a focus towards the more cyclical areas of the market and where we think that nominal GDP growth will benefit. So that has been a little bit of a headwind, but obviously on the flip side, we've mentioned gold, which has been a tailwind to performance. So you've kind of got both sides of the coin slightly driving the portfolio performance there. I guess before we finish, we should probably talk a little bit about the outlook, and why don't you have the final word in terms of that, Jon?
Yeah, so I mean, the recession this year was the dog that didn't bark, and we don't think there's going to be a recession next year. We think probably there's a 25% chance in the US, and if it does happen, it will be through some exogenous shock to the market that wasn't necessarily to do with consumers or economic agents suddenly, shutting up shop. So we think next year's a year of reasonable growth. We think it's a year of further monetary policy stimulus, lower real interest rates, and also decent earnings delivery. And I think we do need to see decent earnings delivery given the elevated valuations that we do see in some sectors, particularly big tech in the US. But I think in the round, it's going to be a year of reasonable investment returns, and a 60-40 equity bond portfolio could easily return 6, 7, 8% next year. But it's also going to be a year, I think, of more volatility, whatever happens, because we've got geopolitics which aren't getting any better. And if it is Trump as president, we're going to have a slightly unpredictable and transactional policy response to a whole range of issues that could certainly unsettle investors in the near term. But the broad thrust of reflation is good for risk markets. And I think the central bank's happy to see inflation maybe close to 3 than 2. There's much more margin for error, I think, in terms of setting monetary policy. So that's a good supportive backdrop.
Good stuff. Thanks, Jon. So perhaps a little bit more volatility, but hopefully broadly positive for asset prices.
Yeah, we think you'll be paid for the volatility the assets generate. Yeah.
Good stuff. Thanks.